It's a pleasure to be here today with you guys and to present you a few things about the options market. So my name is Guilhem Chaumont. I'm the CEO of FlowDesk. We are basically building a market data and trade execution infrastructure for the digital assets. So today I'm going to tell you a bit about the options market and what we have seen in the past days in terms of implied volatility. So we have seen quite an interesting surge, in the implied vol since the last 2 weeks of April, I would say. And actually the spread between the implied vol and the realized vol is at its highest level since 2019. Of course, if we exclude the events of last March. In terms of volume, we also see a similar surge where we have more or less a factor of 4 in terms of volume, with about 200 million USD traded daily on derivatives. But in terms of pure market share of volume relative to the futures volume, this is still only about 0.5%, which is interesting because if you compare that to the open interest share, you see that the options still hold about 20%. So that can give some insight, about the strategies that are used here, and typically options are used for hedging or for more long-term exposure. So that's why there is much less rotation in the portfolios, and that's why the volumes are relatively low compared to the open interest. Now I want to show you a few cryptocurrency option-based strategies that are relatively simple for the rest of the year. Of course, you can read the full disclaimer. This is not financial advice and it's more a quantitative exercise. The first typical strategy that we would want to try, especially if we want to bet on the reintegration of the all-time high, is a kind of binary, try to mimic a binary exposure. So we can do that through a call spread, 20-24K. So the average implied vol you would pay for that is relatively high compared to the past, as we have seen that the volatility is high. It's about 90%, and that would cost you about 1.42% per notional, per BTC of notional. The exit scenario is quite interesting because you would not necessarily want to hold until maturity, which is in December 20, but you would probably want to exit as soon as the levels of 20-22K are reached. And the reason for that, notably, it's because of the appreciation of the option itself, because of the delta, but notably because of the row effect. So the row effect is the fact that, on the contrary of the capital markets, the risk-free rates or the premium that we see on the futures do have a strong impact on the pricing of the options. And because we see this rate ranging from 2% to 15%, back to 5% and back to 20% only in a few weeks, we can really get some good carry from that. Right now, the premium is at 2%, and because of the positive correlation, you would likely see that premium go up to, again, level of 15% in case of a reintegration of the 20K. One of the strategy, which is more on the hedging side, and especially if we expect and we want to protect ourselves against another long squeeze like the one we had, is to get some exposure through the short side, through options in the 4K, 5K area. This strategy is particularly interesting if you want to maximize your BTC holdings because of the convexity you have in the Bitcoin payout, because it's paid in BTC versus the underlying being in USD. You have an interesting effect, which is that your payoff in BTC tends towards infinity when Bitcoins goes towards zero. So you would have a great appreciation of your capital in case you have a significant spike to the downside, as you can see on the white curve here. And the last strategy I want to present you is more to bet on the volatility. As we've said, it's relatively high compared to the levels we've seen in the past, which are usually in the 75% area, so not in the 90s. It's a reverse convertible type of structure where you would sell on a quarterly basis puts at the money, maybe want to hedge them with puts that are 15 to 20% lower than that. What you would get is that you would get coupons every month, which corresponds to the premium of these options. This coupon is about 60% on an annualized basis, so that's interesting. And and you only take the loss of Bitcoin for only about 15 to 20%. So that means that if Bitcoin remains steady or slightly increasing, you only get the coupons, but you don't take the loss. And that's quite interesting, because you're going to get a nice risk-reward ratio where you will have this 60% performance, and you can decide, to renew on every quarter based on the volatility. If the volatility is still high, maybe you want to renew the strategy. If the volatility goes down to, let's say, 60%, 50%, you might want to ask whether or not this is worth it, and so on. So as you can see, we have this very simple structure that are kind of like paving the way for more complex structured products. These products are quite interesting, and maybe they will make the bridge between the traditional world and the crypto world by, providing a way for people to get exposure to Bitcoin and to digital assets in general without having, the significant risk that it holds. So we are really confident that these products will become more and more effective, more and more used, but it will take years, of course, and I will leave you with that. And I would like to thank you very much for your attention.